Okay, well, Mark Matthews of Bank Julius Baer is now joining in to run us through what he makes of the setup. Mark, good to have you with us here. Thank you very much. Will we have is it possible we get a bit of a earthquake later today with, Fed Chair Powell's speech, or you think it'll be, will you use that as an opportunity to indicate that, well, perhaps there is more coming and we are not at the so-called neutral rate?
No, I don't think he'll talk about the natural or neutral rate, or if he does, he will simply reiterate that they are low, sort of around 2.5%, which is what the Fed has been saying for some time in its forecasts. And as Sonia pointed out, it's not typically the venue for really groundbreaking changes in policy. Last year was a bit of an anomaly in the sense that he ended up being a lot more hawkish in Jackson Hole than he was going into it. But this year, I see no reason for him to do so. I don't think the backdrop is one that necessitates a dramatic escalation in the hawkishness. I mean, Treasury yields are, as you know, well above 4%. So the market has already kind of priced in the Fed keeping rates high for some point in time.
So since this is not such a big event and, the market is perhaps going to move on, how are you feeling about the market in general, Mark? Because there is this expectation that perhaps the U.S. could head into a recession, consumption is slowing down a bit, inflation concerns persist globally, right? Not just in the U.S. What do you do at a time like this with risky assets like equities?
There are a few indicators that would suggest an impending economic downturn. For example, commercial real estate loans and some of the credit card data. But apart from those, the data is suggesting actually a very strong economy. And the one I would point to highlight most of all would be the Atlanta Fed's GDP Now forecast for the third quarter, which is inferring, I think the latest is 5.7% quarter-on-quarter growth based on 10 high-frequency inputs. And so there are a few outliers, as I said, that suggest a recession, but I think they're too much of a minority, if you will. I don't think there will be one. I think the economy is strong. And how that translates into the market is that it means rates can stay high, and we are on about 20 times forward price earnings. So I don't see the market going higher in the next month or two. I think probably it should drift down, if for no other reason than the fact that June and July were up 10%, which is way above what the summer months usually are. Summer months are usually about a 3% rise. And so I think it's totally normal that we'd give back some in August, and September 1 is one of the rare months of the year, which on average, if you look back historically, is a down month, on average by 0.7% for the S&P. But I don't see a collapse because I do think that going forward, the earnings are going to improve, and we'll probably have in excess of 10% EPS growth for the S&P in 2024. So if that's the case, the market can grow into its earnings.
All right. Hi, Mark. Good morning. How do you approach the Indian markets? Mark, in the last 1 month or so, you've seen the dollar index move up by close to 3.5–4%. Brent crude prices as well are up by close to around 5%. But the Indian markets aren't ruffled as of now. We're not seeing any big pullback. Your take on the Indian markets, because these are clearly risk for our Indian equities.
Yeah. We're constructive on the dollar, and that is a headwind for emerging markets, including India. No denying it. But I do think that the change in the macro landscape in India, both fiscally and the current account, they speak in favor of the rupee not losing a lot of value. So I'm not that worried about the rupee. And what I would say, your other question, it was dollar. What was the other one, Nigel? Sorry, you mentioned something else.
Crude oil prices
anyway,
as well have spiked.
Oh, yeah. So we're not constructive on oil. We're looking for $75 a barrel 12 months from now. There's ample inventory. In fact, the inventories are going to they're going to start overflowing in Europe pretty soon. They can't handle anymore. Their inventories are so full. And likewise in the U.S. and China. So the reason we had a spike in oil during the summer was simply that the futures market was very, very short oil. And then you had the Saudis extending their cut into September, but they're not going to do all the hard work and let the other oil producers just ride on their coattails. So Don't think oil is an issue. And I like the Indian market. It's got I think it just has everything going for it now, from earnings growth to all the benefits of the structural reforms starting to kick into the economy. We like it very much.
Okay, so you like the Indian markets very much. Got that. I think that's been your base case for a while now, right? Through the course of 2023. Within the Indian markets, do you prefer banks? Do you like IT stocks? And what should the allocation be now towards sectors for the rest of the year?
We've always been fond of banks, and we also like the materials on the back of the increased infrastructure spend and consumption where it is attractively priced. We would be buyers of, but selectively, because a lot of those stocks are overhyped. But the idea in India is that the middle class will grow, and with it, consumption. And I think a very important ingredient there is the increased participation of the middle class in the stock market through SIPs will, over time, make people wealthier. And that is a big reason why the consumer is 2/3 of the U.S. economy, is because equity ownership is high in the United States. So the middle class benefits from the rise in share prices. They don't in many other parts of the world. And that makes them feel wealthier, and they spend more. So those three sectors would be our preference.
All right. Thanks a lot, Mark, for stopping by. Have a great weekend, and hopefully we'll hear from you very soon again. That's the word coming in on the markets. They like the Indian markets, but they're also constructive on the US dollar, which means it's a negative for emerging markets like India. So that's the viewpoint. Let's slip into a quick break, but it is the last trading day of the week. So our entire research team will be up in just minutes from now to tell you about the top 10 stocks to watch out for as we begin the day.